Recessions create more millionaires than any other time because when you see an economic slowdown, it creates opportunities for financially savvy people to go out and buy good investments at a discounted price. I'll show you. Right now, we're facing a very unique challenge in our economy because on one hand, the economy is slowing down. Secondly, the Fed says that they expect our economy to enter a recession by the end of 2023. And third, we are seeing some of the lowest unemployment levels in the last 5 decades. Which means we have most people who want a job able to go out and get a job. Companies are still struggling to find labor. And if you have an economy where unemployment is at some of the lowest levels ever, how could that mean that we're facing a potential recession? Well, the unemployment numbers that we're seeing right now are a bit skewed based off of what's happening in the economy. Now, of course, some people who are trying to find a job can't find the right job for them. They're not happy with the pay, or they might not be happy with, the overall career that they have. But the bigger issue is what types of jobs are available and what's going on with those jobs. And the best way to understand this is just to kind of backtrack to look at how our economy got to where it is today. Because when the pandemic hit in 2020, we saw a ton of stimulus happen. Now, this wasn't just stimulus checks and unemployment checks. This was also to businesses, and interest rates were cut to their lowest levels ever, which means if you were a business, you could go out and access millions, hundreds of thousands, maybe even more money, billions potentially, at very low rates, meaning you could borrow and get access to a lot of money for very cheap, meaning it was very easy during that time to expand. Businesses were opening up new divisions, they were opening up new stores, they were opening up new restaurants, they were opening up new places, new factories all over because it was so cheap to borrow money. If you could go out and get money at 2 or 3%, you only need a 4, 5, or 6% return on your money to justify that investment, and you just doubled your investment. And so businesses were expanding like crazy across the board, from startup to established businesses. And this created a huge economic boom, which meant businesses were hiring like crazy because there was so much money to be made. Because if I could go out and borrow $1 million at very low interest rates, I could borrow it for 2 or 3%. Well, now I could take that $1 million and open up a new store or a new office or a new factory or whatever, hire a bunch of people, and I only need that money to grow by 5 or 6% for it to be a good investment. And so we saw this massive boom happen, meaning overhiring happened in 2020, 2021, even into 2022. And now what we're seeing happen is the opposite. Interest rates are going up because of all the inflation that we're seeing, which means that these businesses who borrowed money at very low interest rates are having to do one of two things. One, they're going to have to either become profitable on their investments, that way they can pay back the loans, or if these loans are now readjusting, because many of these business loans are not 30-year fixed rate mortgages, they are adjustable rate mortgages. So now in the coming 24 months, as more and more of this debt comes due at the higher interest rates, their costs go up. And that also means that if they can't become profitable, then they're going to have to downsize. And this is the shift that we're seeing happen, where a lot of the businesses that boomed and grew over the last few years are now having to adjust because they grew too big too fast. And so that means a lot of downsizing, a lot of reducing of staff, a lot of shutting down of operations because it was too much, costs are too high, and the profitability isn't there. And so now we're going to be going through this downsizing phase because over the last few years with low interest rates, we were in this boom phase because everybody was trying to grow their market share. Everybody was trying to capitalize on all the free money that was out there, but that free money is gone. Interest rates have gone up more than 10 times consecutively in the last 18 months. And now we're facing a situation where the higher interest rates are really posing some threats to the economy. We saw it happen in the banking sector, but it's not contained to the banking sector because businesses borrow money. They're not always fixed rate mortgages. Actually, most of the time, they're not fixed rate mortgages. So we have a few different things happening. Number one, we have the economy downsizing because of all the boom that happened over the last few years, plus the higher interest rates, which is now causing a slowdown in the economy. And secondly, we still have very high inflation, which is also slowing down the economy because the high inflation is making it more expensive for people to be able to go out and spend money on other things that they want because, well, you have to spend more money on your rent or your mortgage, you have to spend more money on your groceries, you have to spend more money on your car and everything in between. So people have less discretionary money to spend. Both of these two things are now creating a slowdown in the economy, which we're now just starting to see. And the question is, where do you see the opportunity? And now to answer that, let me ask you a question. How do you become wealthy, or what makes you wealthy? Is it A, a big savings account, B, a big salary, C, owning a lot of assets, or is it D, getting a lifetime supply of Sweetgreen? Now, if you've been following my channel, you know that this answer is pretty simple. The answer is D, a lifetime supply of Sweetgreen. The answer is C, owning a lot of assets. The answer is not having a big salary, because even if you make $1 million a year, if you live $1 million lifestyle, well, you're just one paycheck away from being broke, because now you make money to spend it. And if your leg breaks and you can't go to work, or if you get fired, or if your company goes bankrupt, you just lost your salary and now you no longer have an income to fund all of your expenses, and now you're broke. That's not real wealth. And the answer isn't having a big bank account, because even if you had $1 million in the bank, well, as soon as you spend $1, you have $1 less to spend. And every time you spend money, your bank is going to be decreasing in size, which is why a big bank account can make you feel wealthy or rich in the short term, but it can't keep you wealthy forever because your savings are fleeting. Your assets, however, can make you wealthy because your assets can continue to pay you even when you're not working. And the way that this works for 99% of Americans is you work to earn a salary. You take the salary that you're earning and you want to take as much of this money as possible, and you want to use this money to buy assets instead of using this money to go out and buy things. The majority of Americans are working to earn more money so they can drive better cars. But if you really want to become wealthy, you got to work to earn more money so you can buy more assets, and then you can use these assets to buy more cars. What are these assets? Well, it can be stocks, it can be real estate, it can be businesses. There's a lot of different types of assets that you can buy. Assets are just things that you're buying for the purpose of making money. But the whole purpose here is you're buying something with the purpose of making money, as opposed to making money to buy something that looks like you've made money. And it's a completely different mindset shift because we're bred and taught to be consumers. That's all we see. Go to work, get paid so you can have nice things, right? Buy a nice home, buy a nice car, go on fancy vacations, have fancy clothes. This is the name of the game that 99% of America is playing. But the reason why some people are so much more wealthy than everyone else isn't just because they had money falling on their laps or because they own the politicians or this and that. I mean, you're talking about a teeny tiny percent of people that have that type of wealth or that have had this money given to them. For the real wealthy, that people that created it themselves, is by working to earn money and then taking this money and buying assets instead of going out and buying nice things. It's that financial discipline. And if you can create that financial discipline for yourself, where now you're not spending all of your money and you're working to take the money that you're earning and you're using this money to buy investments, well, now you have a real shot at becoming actually wealthy, depending on how much time you put into it, where you invest your money, and how aggressively you're doing this. And this is where now looking for the better opportunities can help you accelerate that wealth, because when you see any sort of economic slowdown, what happens is asset prices fall. And the reason why asset prices fall is, well, multifold, but these asset prices fall, and then you have the opportunity to then go in, buy more assets for the same dollars as before. Because now if a stock falls by 40%, you can buy 40% more stock with the same amount of money as before. And the reason why this is so risky or scary for a lot of people is because when you see asset prices fall, everybody's running away from the assets, and most people don't want to go against the grain. They don't want to go against what everybody else is doing because they want to feel comfortable and they want to follow what everyone's doing. I mean, that's the trend. Most people want to do what most people are doing. But if you really want to become wealthy, and you want to become wealthy sooner rather than later, you can't keep doing what the majority of people do. So why do these good investments go on sale? Well, if you ask Warren Buffett, he says that the best investment opportunities are when other people do dumb things. These dumb things can mean somebody goes out and they buy an investment with way too much debt that they cannot manage, and then they become over leveraged, and this asset price falls, and now they have no option but to get rid of the asset, or the bank takes this asset over and they have to sell it at a discounted price. That's a dumb thing. Another dumb thing is taking on way more than they're willing to lose or can manage. You see this happen a lot in real estate, where people get excited in a booming economy. They go out and they take on too much real estate. They use too much debt. They don't know how to manage the properties. Then things slow down and they don't have a way to keep maintaining and managing the properties. And now they're forced to liquidate and sell off these properties at a huge discount because they couldn't keep maintaining it. Another dumb thing is you see people selling. You panic and you sell off your good assets because you hear the news talking about how the world is ending, how everything is going to come down. So people sell off their assets. There's a lot of reasons that can trigger a sell-off. And at its ultimate core, the reason why asset prices fall is when you have more supply than demand. The price of anything is what somebody else is willing to pay for it. And when you have a lot of people selling an asset, whether it's stocks or whether it's real estate, it does not matter. If a lot of people are selling and not as many people are buying, that's going to pull this asset price lower. And so now if you see news of the world ending, you see news of all these crazy things happening, people get scared naturally, especially nowadays with the news. Information is spread very quickly. Fear, panic, greed, excitement, all can be spread very quickly. And when people see whatever's happening and they get emotional, well, that could quickly trigger you to want to either purchase or sell an investment at a time where maybe you shouldn't, just because you get excited or because you get scared. And we've seen this happen time and time and time again. But now, because of social media and how quickly things are transferred, this is amplified, this media effect. Because now when things are going up, all you hear is people talking about how much money people are making, how nothing bad can go wrong, how the economy is booming, and how you have to get in now before it's too late because people are making so much money. And then this gets amplified with social media. When things are going down, it's the exact opposite. You hear the media talking about how the world is going to end, how the economy is on the verge of collapsing, how everything's going to go wrong, how it's going to get much worse. And then this gets amplified with social media, and this triggers a broad sell-off. And so now, your job as a savvy investor is to ignore the noise, cut through all the emotions, and look for the financials. And the best way to do that now is by actually studying the raw data instead of just trusting a headline. And if you don't want to or don't have the interest or don't have the time to do that, then the next best thing will be to join something like Market Briefs, which is my free financial newsletter, where every day my team is working to break down what's happening in things like the housing market, the stock market, the economy, the crypto market, the global economy, and everything in between. It's completely free. You can read Market Briefs in less than 5 minutes every morning. And I got the link to how you can join down in the description below. Now, I know that was a shameless plug, but the reality is you want to be able to dissect the raw data of what's happening. It means getting a real pulse of what's happening, because if you're invested into an asset that is struggling because everything else is struggling, that creates a great opportunity for you to come in and buy more of this asset. Now, this doesn't mean that every asset is going to be a winner. Some are going to lose. Every time you see a slowdown, you see some bankruptcies happen. You see some foreclosures happen. Some investments will go down to zero. Your job is to be able to decipher and discern which ones are going to zero and which ones are going to survive. And this is where that research parts come in, where now you're going to be researching your investments, you're going to be analyzing the investments, you're going to be studying the financials and looking for good investments that's selling at a discounted price. Now, if you're saying, but Jaspreet, I have no idea how to do that. I don't have the time to do that. I don't want to do that. That's okay. You don't have to. Not everybody has to be a super active or involved investor. You could do the next best thing, which is investing in funds, something like an ETF or a low-cost index fund. These types of funds will give you broad exposure to a certain index. So if you see the economy slow down, then you generally see the stock market get hurt. And then you can just go in and buy ETFs to give you exposure to the broad stock market. Now, I'm going to give you a couple examples. I'm not telling you what to invest in, just giving you a few examples. VTI is an ETF that gives you exposure to the total United States stock market. SPY is an ETF that gives you exposure to the S&P 500. That's the 500 largest companies in the stock market. DIA is an ETF that gives you exposure to the Dow Jones. And QQQ is an ETF that gives you exposure to the NASDAQ. These are some of the broadest ETFs out there. And now, if you just want to get exposure to the economy, you can pick some of these ETFs and get broad exposure to the economy. This is a way now for you to come in and buy assets at a discounted price. But the key here for this to work is you have to be invested for the long term. You have to be patient, and you also have to know how to buy. Because if you're just going to come in and make one purchase, the big debate and question everybody has is, well, when do I actually buy? Do I wait? Do I buy in 2 weeks? Do I buy tomorrow? How do I find the bottom? And nobody can perfectly predict the bottom. Nobody can perfectly time the market. And the people that try to time actually end up losing the opportunity to make so much more money because they're constantly just waiting for that bottom price. And for a lot of people, it never actually goes low enough. When you see the stock or the investment going down, you say, you know what, I just wanted to go down 5% more. And if it goes down 5% more, I'm going to buy. And then it falls 12%. And now you're like, you know what, just 5% more. I know it's going down now. Now I'm just going to wait a little bit more. That way I can come in and get an even better deal. And then you're waiting and waiting and waiting. And that's when that stock pops off. And now you're like, well, now I don't want to buy. I want it to come down even lower. And now you missed the opportunity to buy. This is what happened in 2020. When the 2020 pandemic happened, and I know this because that was the first time that we saw a market crash, and I was on YouTube for me to actually witness this happen. But I was talking publicly about how when the pandemic happened, how I was buying stocks in phases, and I was buying them on the way down because, everything was just crashing. And I would get these floods of comments of people saying, dude, you're so dumb. Why would you want to buy now? The market's going to collapse. Wait for it to go down lower. Wait for it to go down. It's going to go so much lower. And I said, sure, I'll just keep buying. If it keeps going lower, I'll buy more. And I'm going to buy in phases. That's why I buy in phases on the way down. And what I didn't predict, I don't think anybody did, I'm not going to act like it did, was how quickly the Fed opened up the money printer and to what extent they fueled the market and the economy and stimulated this whole machine to start working again. I didn't predict that to happen, but they did. And immediately you saw the stock market turn around after the 2020 pandemic to one of the fastest market booms that we've ever seen in history. So now, what does this mean? You can play the game of trying to perfectly time the market, and if you hit it, yeah, you can make a lot of money. But the chances of you hitting that perfect bottom are next to nothing. Even Warren Buffett doesn't do that. So now understand, what is the game that you want to play? And for me, I play two games. I play a passive investing game and I play an active investing game. And again, I'm not telling you what to do. I can't do that. I'm not a licensed advisor. I'm just here telling you what I do. That way, maybe you can go out, start learning, and start putting your money to work. But when I have my passive investing system, I have a game where every Wednesday, I'm calling it a game just to talk about money. I'm not actually playing a game. I have a system where every Wednesday, money is pulled out of my checkings account and it's invested into a portfolio of different ETFs that I have. I have ETFs that give me exposure to dividends. I have ETFs that give me exposure to value ETFs. I have ETFs that give me exposure to innovation, and I have ETFs that give me exposure to companies and countries overseas, so international companies. These ETFs every Wednesday are getting more money deposited into it, whether the market's up, whether the market's down, it does not matter. This is my long-term play that I don't really touch. It happens all by itself. I don't have to do anything. This is on whether the market's up or down. And the only thing I might change is if we see the market go down, maybe I'll invest more money, but that's it. On the active side, it's very different. Now I have cash put here where I'm actively looking for cool companies, innovative companies, undervalued companies that I want to come in and buy. Now, this is more work. This is where now I'm actually researching individual companies. I'm listening to their earnings calls. I'm reading their financials. I'm keeping up with the company, who's running the company, and what's going on with the company, and what products they're innovating with for individual companies for me to come in and buy. Now, for this, I don't buy until I see a good price, which means I might not buy for a long time until I see the price of one of the stocks that I want to buy come down. This is a completely different game, a much more involved game. And this is where most people, the vast majority of people, should not be investing in individual companies, because investing in more individual companies is riskier. Because now, if you invest in the Amazon company, it could take over the world and you can make a lot of money. But if they go bankrupt, you're going to lose everything. And most people don't have the financial education to research a company and keep up with that. And they don't have the psychology to understand that and to manage their investments the right way, or the risk management to manage their investments the right way. And so investing in individual companies, yeah, you can make a whole lot more money, but you also take on more risk. And if you're not willing to take on that risk or put in that time or put in that effort, stick with index funds or low-cost ETFs. That way now you can get broader exposure and not have to worry about trying to manage a portfolio, because what we've seen happen time and time again is so many people end up losing their money in the stock market, when over the last century, we have seen the stock market grow by 7 to 10% a year on average. That doesn't mean that the stock market always goes up. It means that on average, the stock market has grown after the wins and losses by 7 to 10% a year. And that's through crash after crash after crash, through the Great Depression, through the Great Recession, and many recessions in between. And so now, if you want to be able to capitalize on these gains, you got to be able to invest your money for the long term. Let's take a look at some recent examples so you know what I mean. Back in the year 2020, when the pandemic happened, it was scary. Most people were running away from their investments because they had no idea what was going to happen to the economy. But looking back, this pandemic crash seems like a no-brainer to invest. But it took a special type of person to invest when everybody else was running away from the stock market. Take a look at the 2008 crash. Back then, real estate prices were plummeting, and everybody was saying real estate was cursed and you should stay as far away from real estate as possible. But again, hindsight is 2020. Now looking back at it, it seems obvious that buying real estate after that crash was a good investment, but it took a special type of person to go against the grain to actually buy real estate when everybody was selling. Now, I'm telling you this from experience because I saw what happened in the 2020 crash with all the comments on YouTube. And when the 2008 crash happened, I didn't have a lot of money. But that was when I started investing in real estate. And I knew people who had way more money than I did, who had access to way more money than I did, but they refused to go out and start investing in real estate because of how negative the sentiment was around owning real estate. Most people, 99% of people, did not want to go out and invest in real estate, even if they had the ability to go out and do it, because of how risky it was, of how scary it was, and how bad things were for the real estate market. Now, I didn't have a ton of money back then, but I used it as an opportunity to start investing. I saw the same thing happen in 2020. People were running away from the stock market when the pandemic happened, but that special type of person that kind of went against the grain and started buying investments. And back in 2020, we had YouTube, and you saw a lot of retail investors come up, and they used it as an opportunity to finally start investing, which is great. But then the people that went in and were buying these investments for pennies on the dollar in 2020 were able to make a lot of money much quicker than I think anybody could have anticipated, because of what happened to the economy with the stimulus and federal quantitative easing to help bring the economy back to life, along with the stock market. What I've found is that people that really build wealth and can capitalize on opportunities understand and do 5 things every time you see an economic slowdown. And number 1 is you do not trust the traditional media. I was saying this just a minute ago, but the traditional media is in the business of selling hype or emotion. That's what gets you to click onto their article or whatever. And I understand YouTube is the same game, okay? If you are on YouTube and you don't have a clickbaity title or an attractive thumbnail, and I'm telling this from experience, it will go into the YouTube graveyard and nobody will ever see it. And I went through this challenge myself because I was not a fan of this. But the reality is, in this game, if you do not have an attractive title or a clickbaity image, nobody clicks it, and that video, that content will die. And so for me, what was important was, 1, creating content that was actually valuable inside of it. And that's one of the reasons why I'm so focused on building Briefs Media, my newsletter brand, because now I can provide news in one email. We don't need any clickbaity titles because all the content is in one email, and we can avoid all the sensationalism. That's why I'm working to build that, because I see all the crap that's on the internet. But most of the traditional media out there, well, it's all about just emotion and sensationalism, because that's what gets people to go and view this. The crazier the content, the more money the media outlet makes, period. And so when you have things going up or going down, What do you think the media is going to do? They're going to amplify the heck out of it. If it's going up, nothing can go wrong. You're going to make $1 million. You're going to make $1 billion. You're going to make all this money because of how great things are. When things are down, the world is going to end. The market might collapse. Is this the end for the dollar? Is this the end of our financial system as we know it? Is this the end of America? The crazier, the more money the media companies make, which is where now you really need to be able to cut through the noise and understand that the financial savviness is ignoring all the noise and paying attention to what's going on with the finances. Number 2 is investing for the long term. I am not a trader. I tried trading one summer when I was in college, trading stocks, and I spent hours of my life. I spent the entire summer doing it. I was waking up before the bell, getting on all these chats and forums, learning about what trades to make, and did this the entire summer. I don't think I made any money. I also don't really think I lost much money, but I spent an entire summer doing it, and I realized trading is not for me. I want to be an investor, and being an investor means you have to own an investment for the long term. That way you can let the investment grow, you can let the investment make you money, and this takes time, and it requires you to be patient, and it requires you to believe in the actual investment that you made. And so now if you buy something and now you expect the economy to turn around and your investment to turn around in 6 months, well, you're probably going to be very disappointed, and that might cause you to sell, especially if things get worse or if things go lower. And this is where now if you want to be an investor, especially if you're investing in volatile times, when things are going wrong, when the economy is rough, when there's a lot of pain and stuff going on, you have to be even more patient and be more focused on what your investment strategy is, because when things go wrong, things can go really wrong. Things can nosedive very quickly, and that's where you have to have that patience to hold on to and believe in your investments and keep up with your investments to know why it is that you're investing. Number 3, you have to understand the cycle. Nothing can go straight up forever, and most things are not going to go down forever. At least most good investments are not going to go down forever. This is a cycle. This has happened in the past, and it will continue to happen. We have seen recessions happen pretty much every decade for the last century. In fact, the longest period in modern American history without a recession was, you want to guess? After the 2008 crash. Between the 2008 crash to 2020 was the longest period in modern American history without a recession. Recessions happen. Yet that little word, or medium-sized word, recession, scares a lot of people because most people are blindsided by it. Most people don't want to believe it's going to happen. Most people don't want to actually understand it. Instead, they just try to ignore it and hope it never comes. But it is coming. It always is. They keep coming, and they will continue to come. And so now what you need to understand is, instead of being the person that gets blindsided by it, understand it. That is the financial education that way now you can use recessions to capitalize on opportunities. This is what wealthy people are doing. They're already doing this. And so now if you want to stop living in your whatever financial situation you are, you need to buy assets. Assets are what make people financially free. Period. You can work to earn as much money as you want, but until you can convert this income into an asset that's producing income, you're always going to be working for money. So now, how do you buy more assets that can produce you income? Buy these assets on sale, or have more money to buy these assets. Now, of course, keep working to earn more money. That way you can have more assets. But when assets go on sale, use it as an opportunity to buy more. And this is where now understanding the cycle is so important, because you're going to go through periods of excitement and greed and so much hopefulness and nothing will ever go wrong. That optimism, when people think nothing can go wrong, is when you definitely want to start taking a step back and start analyzing where you are. When you go to the opposite side, when everybody thinks nothing can go good and only bad things will happen, well, now that's when you want to come in and start sniffing and looking for the opportunities. And so this is just a matter of you going against the grain and not doing what the majority of people do. Number 4 is prepare when times are okay. Because now the way that you capitalize on these opportunities is, 1, being financially educated to find the opportunities, but then 2nd is having access to money that way you could actually go out and buy some of these good investments, whether it's stocks, whether it's real estate, whether it's businesses, whether it's cryptocurrency, whether it's whatever investment that you want to own. You have to have the ability to purchase it. And if you have no money because you're broke or because you don't have any savings, you're not going to be able to capitalize on it. So how do you do that? Well, you prepare when times are okay. When things are good, you don't want to be living like everybody else and spending all of your money. You need to start building a reserve that way you have cash, one, to protect you, but also to be able to capitalize on opportunities that might come your way. And the way you do that is by preparing when times are okay. That's why I keep saying that 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. And number 5, you need to know how to manage your risk. This is how you are investing your money and knowing that you're not investing more than you're willing to lose. Especially when you're going through volatile economic periods, you're going to see things get hurt. You're going to see investments get hurt. You're going to see some investments go under. And that's part of the risk. And so you need to know, what is your risk tolerance? How much are you willing to lose? What happens if your investments go down? Do you have a sell parameter if it goes below a certain price? How are you managing your investments? How do you know that the investment that you made is still doing okay? How often are you keeping up with your investments? This risk management becomes very important, especially if you're investing in individual investments, individual stocks, individual pieces of real estate. That way you can manage the cash flow and manage the investments that you have. When you're investing in ETFs, it's a little bit less risky, but you still need to be able to manage the risk and know that you're not investing more than you're willing to lose. That way now you could go out and actually make money from the investments that you're making. Once you understand this, now you can look back at history to understand what might be coming in the future. Take a look at this. The average post-World War II recession has lasted 10 months. That article was from Forbes. And if we back up a little bit and we go back from the 1850s until now, the average recession lasted 17 months. Now, part of the reason why the average recession length has gotten shorter over the last number of decades is partially because in 1913, the Federal Reserve Bank was created, and then the Fed had the ability to manipulate our monetary supply by printing more money or cutting interest rates, which allows them to stimulate and influence the economy, especially when we're in a recession. But here's what I want you to remember. Recessions happen and nobody can perfectly predict when. Recessions generally happen when nobody expects it to happen. Right now, the Federal Reserve Bank is saying that they expect a recession to happen by the end of 2023. Now, will that happen? Who knows? But the reality is we're seeing a lot of red flags in our economy. Maybe the real pain for the recession won't happen until later on. But now, this is where you want to be paying attention to what's happening and know that just because everybody's saying something's going to happen at a certain time doesn't mean that it's going to happen exactly at that time. But if you understand that recessions happen and you understand how long recessions last, it might help you manage and invest your money a little bit better. Take a look at this. In 1945, we had a recession that lasted 8 months. In 1949, it lasted 11 months. In 1953, a recession lasted 10 months. In 1958, a recession lasted 8 months. 1960, 10 months. 1969, 11 months. 1943, 16 months. 1980, 6 months. 1981, 16 months. 1990, 8 months. 2001, 8 months. 2008, 18 months. And 2020, 2 months. While the majority of people are arguing over whether or not we're going to see a recession, I want you to understand that recessions happen, know how to prepare for them, that way you can capitalize on a recession. There are a lot of recession indicators out there. Every economist has their own recession indicator that they look at, but let's take a look at a couple of them. Number one is the Warren Buffett indicator, the Buffett indicator, which takes a look at stock valuations. And what it says is that when stock valuations get so hot, that is an indicator of a recession. So think of it this way. If you start a company that's making $100,000 a year in profit, how much is this company actually worth? Is it worth 10 times your earnings, $1 million? Is it worth 15 times your earnings, $1.5 million? Is it worth 20 times your earnings, $2 million? Or is it worth 50 times earnings, $5 million? And it's really just going to depend on, one, what type of company you have, but then also how strong is the economy and how much free money is available. When you have a lot of money available, when you have access to cheap debt and a lot of quantitative easing and a lot of stimulus, a lot of dollars out there, valuations naturally rise because people and investors and institutions have access to more money. And so now these institutions are going to be fighting each other to invest into your company or buy your company, which then pushes up valuations. Right? There's a lot of demand for your company, which pushes up the price. So what the Buffett indicator says is that when they see valuations rise significantly, that is an indication of a hot period in the economy, which ultimately, when the economy gets too hot, it's going to have to cool down. And that's what the Buffett indicator says. And we've been seeing this Buffett indicator start to cool down, but it has been saying in the past that we are in a hot territory. Some investors look at the yield curve indicator, which says essentially, if I'm going to lend my money to the government for 10 years, I would expect a better rate of return than if I'm investing my money and giving my money to the government for 2 years. And that makes sense because if I'm investing my money for a longer period of time, it's riskier to me, so I deserve a better rate of return. But when that flips, meaning I'm getting a higher rate of return by lending my money to the government for 2 years as opposed to lending it for 10 years, that is an indicator of a potential recession coming because it means that people are worried about the long-term health of the economy, the dollar, and the government. And so they don't want to lend their money to the government for the long term for 10 years because I'd rather get a better rate of return today. So if you're getting a better rate of return in the short term by lending your money for a short period of time, you don't have much incentive to invest your money for the long term because you're getting a better return by lending your money for a shorter period of time. This is what some people also call a recession indicator when you see this type of inverted yield curve. Now, it doesn't really matter which indicators you're looking at because at its core, a recession ultimately comes down to the exact same things. It means that people are not or do not have the ability to continue spending money because our economy runs on spending. The more money you spend, the more money somebody else makes. When you go to Sweetgreen and you buy a bunch of stuff, they make more money. If Sweetgreen makes more money, they have the ability to open more stores, hire more people, create better products. If you're not spending money at Sweetgreen, they don't have the ability to open more stores. They don't have the ability to hire more people. And when you see that happen in the broader economy, the economy then slows down. So the economy runs on spending. And when people are spending, businesses make money, the economy grows. When people are not spending, businesses don't make money, the economy is shrinking. And so when you see a recession happen, that means people don't have the ability to spend. What causes people to lose their ability to spend? Well, you could say if businesses are doing layoffs, they don't have the ability to spend. And that's correct. But what's going to cause a business to do layoffs? Because if a business is growing and they're making money hand over fist, they're not going to do layoffs. There has to be something that triggers the layoffs. And the layoffs and the slowdown is triggered by people's reduced spending. Because if a business sees their revenues or their profits fall, that's what's going to trigger them to do the layoffs. So what ultimately causes people to not spend their money? And this goes down to consumers and businesses' spending ability. When people have the money to spend, they can and will spend. When people don't have the ability to spend, they won't. And when I say money, I don't just mean the money that you're working to earn. I mean money in our economic system, which means the money you work to earn from your job and also credit. We live in a credit-based society, which means the money in our economic system is the money you work to earn, the money in your savings account, and the credit you can qualify for. And so now, when people go out and you spend, well, what we see happen is people then continue spending even beyond their means because now you can go and put some money in your credit card. You can get a home equity line of credit. You can go and get some loans. And so now you can spend. And then ultimately, you hit a breaking point because now you spent too much money. You have the money that you're working to earn, and you've maxed out your credit cards, you've maxed out the debt, and now the money you're working to earn has to go to paying down your previous debts as opposed to buying more things. When this happens in a collective, that means now people, businesses have spent it all. You've overspent, and now instead of going out and spending more, you have to work to pay down and pay back your previous purchases. When you enter that phase in the economy, now spending has to go down unless something changes on the credit side, meaning the Fed makes more money available, loosening credit standards or whatnot. But in general, if that happens and spending ability decreases, well, now people are working not to buy more things, not to buy more Sweetgreen, but to just pay back all the credit card bills. And when that happens, you see a slowdown in spending because people can't go out and shop. They can't go out and buy more things. They can't go out and spend freely like they could before because now they have spent too much, and now you're working to pay down the debt. When you enter that breaking point where now people are working to pay back bills as opposed to creating more bills, that's what then causes the slowdown. And when you start to see that slowdown, well, that triggers the next domino. It's a game of dominoes at this point because now the spending slows down. That means businesses see less revenue. If businesses see less revenue, well, some businesses are going to go bankrupt, maybe because they had too much debt, maybe because they were mismanaged. They might just go straight up bankrupt. Other businesses will say, okay, now we need to readjust. We need to lean our operations. They might let go of some divisions. They might lay off some people. When you see these things happen, that then triggers the next domino, which is people lose their incomes. When people lose their incomes, well, you also don't have the ability to spend. And you might not have the ability to pay back your debts either. So now you have the next domino, which is not only are people not spending, but now people don't have the ability to pay back their bills because they're losing their income. And then when that happens, that's when the banking sector starts to get hurt, because now banks are not getting their money back. They're not getting their loans back. So you can start to see it's a game of dominoes, but it all starts with the spending. And let's take this analysis and put it to what's going on today, because what we've been seeing happen after 2020 especially is we saw a huge ability for people to load up on credit because interest rates were so low. And so we saw people spend because one, they had access to this credit. And then second, because, well, inflation made everything so much more expensive. So people had to spend more money to buy things. And in the beginning, it wasn't that big of a deal because people had stimulus checks, they had unemployment checks. People had the ability to spend. Well, now as that free money is going away, as the price of things are still high, and now as interest rates are getting higher, we're starting to see the real effects of that. And the first effect of that is on the debt side. We are seeing people in America increase their debt spending across the board. Poor, rich, middle class, everybody is increasing the debt spending. And at the same time, we're also seeing people now start to dig into their savings as a way to continue maintaining their lifestyles. Because now when you compare the two evils, which is, do I go into debt to continue funding my lifestyle, or do I shrink my lifestyle? That way I can afford what I have. What we're seeing is most people are saying, I don't want to shrink my lifestyle. I'm just going to go into debt to continue funding my lifestyle because it's a lot harder, especially in the short term, to buy a smaller home, have a not as nice car, have not as many vacations, to have less things than it is to just put it on your credit card. So now we're seeing the debt spending rise. We're seeing people dig into their savings accounts. And so we're starting to see spending fall. And it's becoming tougher and tougher for the Fed to now inject more money into the economy because inflation is so high. The reason why the Fed has to keep raising interest rates and why they've been raising interest rates is because inflation still is not under control. And when you have inflation that's high, it's hard for the Fed to make credit and this other money more accessible to people because, well, that's going to make inflation even hotter. So now, this is that situation that we're in where we're now starting to see the spending slow down. And the question is, what's going to be the next domino to fall? This brings me to the natural next question. Should you wait for a market crash to begin investing? Everybody is holding their breath in the economy right now. It feels like every week more and more institutions are coming out and saying or forecasting a recession is coming in the economy, which brings up a tough question. Should you begin investing today, or should you wait for markets to crash and then come in and buy at a discounted price? And the reason why this question is so difficult today is because if you save that money waiting to invest, your savings are being eaten away by inflation. But if you go and invest the money and then you see the markets crash, you could see the value of investments get cut in half. So what do? Well, let me start with this. At the very least, for your savings, consider getting a high-interest savings account. There are a lot of high-interest savings accounts out there right now. Make sure they're FDIC insured. You can do your own research. But there are a lot of accounts that are paying somewhere between 3.5% to 4.5% in interest on your savings. These are legitimate banks that are FDIC insured that are paying out this interest, 3.5% to 4.5% right now on your savings, and it's not a CD, your money's not locked up. So if you don't have a high interest savings account, definitely something for you to consider. Now, of course, do your own research and do your due diligence before you go and just throw your money into any bank. From there, the next thing you want to take a look at are what are the possible options of things that can happen. Option number one is we don't see any sort of economic slowdown. The economy continues to boom, at which case buying now would be the best option, because if the economy continues to grow better than expected, well, then buying today would probably be a better option. Option number two is we see an economic slowdown, but we're also facing extremely high inflation, at which point, well, you'd want to buy when asset prices go down, but saving your money would also be losing you money because of the high inflation, where now if you own something like gold, which is a traditional inflationary hedge, you could then sell that gold and use that gold to buy some of the assets at a discounted price. Option number 3 is inflation continues to cool and you also see a recession or a market crash coming where now savings would have the ability not to lose as much value to inflation, and then you can use these savings to go out and actually buy your investments at a discounted price if you see a market crash. Now again, I can't tell you what to do and I don't want to tell you what to do because everyone's goals are different, everyone's risk tolerance is different, but I will tell you what I do. Now again, this is just what I do. Don't go and copy what I do. You need to create your own investment plan. I invest my money a few different ways. Number 1, I have a passive investing strategy and an active investing strategy, and then I invest my money into a few different asset classes. Let me start by talking about the asset classes, then go into the different strategies that I have to invest. And again, this is just what I do. I invest some money into my own business, I invest my money into physical real estate, I invest my money into stocks, I invest my money into cryptocurrency, and I invest some of my money into physical gold. These are the different places that I invest my money. And also when it comes to my own business, I also invest in other startups as well. Now, some of this is passive, some of this is active investments. So my passive investing, which is now every week or every month or every day, I have money that's leaving my checkings account and it's automatically invested. I have my stocks, which are my ETFs that I invest in. So every Wednesday, I have money that's leaving my checkings account and it's invested into my portfolio of ETFs. This happens whether the market is up or down. It does not matter. This is always happening for me. I also have passive investments into cryptocurrency. Now, my cryptocurrency investments I know are very speculative. They're very volatile. It can go to zero, and I'm okay with that. It makes up a small piece of my portfolio, but I believe in the value of cryptocurrency and the blockchain, and I'm not investing in a lot of the smaller coins. I'm investing in mainly Bitcoin and Ethereum. Again, I'm not telling you what to invest in, just telling you what I do, but I understand that this could go down to zero, and that would be just fine. That's how it's positioned in my investment portfolio, but I'm buying some cryptocurrency every day, and then I buy physical gold every single month. Now, my gold is not a huge piece of my portfolio. This is about 2% of my entire investment portfolio. It doesn't generate me any cash flow. I don't really pay attention to the price of gold. For me, this is just an alternative way for me to save money. I look at it like saving hard money. If I was to take $10,000 worth of cash today and $10,000 worth of physical gold today and bury it in my backyard, I think in 10 years, my physical gold will have more buying power than the cash. That's my theory, which is why I own some physical gold. I don't really pay attention to the prices of gold and all that. For me, it's just an alternative way for me to save money. It makes up about 2% of my portfolio, but every month I'm buying some physical gold. That is my passive investing strategy, period. My active investing strategy is number 1, I'm actively taking money, putting it back into my own business, Briefs Media, because I want to grow my newsletter brand. And my theory and opinion is as we continue to see the economy slow, we're going to see more ad revenue dropping. When we see ad revenue dropping, that means 2 things. 1, for media companies, that means they make less revenue. Briefs Media is a media company. We make less revenue when people are not advertising because our newsletters are run through sponsorships. We have an advertisement section in every newsletter. And so when ad revenues drop, well, we make less money. But at the same time, we can also benefit because if ads are dropping, that means we can go out and grow our newsletter through advertisements at a cheaper price because now we're competing against less people. So that's one way that I'm going to be capitalizing on an economic slowdown through less ads. Because 1, we'd be making less money, but we'd have the ability to go out and actually run more ads. Now you might be wondering, how are we going to fund more ads if we have less money coming in? Well, because I've been kind of predicting and thinking that the economy is going to slow down and ad revenue is going to slow down for a while now. So it's something I've been preparing for. Second, with real estate. I invest in real estate, but I have slowed down my real estate investments significantly, partially because I've been investing a lot more into Briefs Media, but also because the deals in the real estate market have really become a lot tighter and I have to become a lot pickier. So when I invest in real estate deals, I am definitely way more picky now because of how high prices have gone and the prices at which people want to sell certain real estate deals or apartment complexes and the returns that they're generating just don't make sense to me. A lot of them don't make sense to me. And I don't want to go out and just jump into buying something if it doesn't make sense because people say, oh, well, rents are going to go up by 10%. And so in 3 years, you're going to be able to make a great return. Well, that's predicting a lot of things are going to happen over the next 36 months, which may or may not happen. So I don't like to get into that speculating game, which is why I've definitely been slowing down my real estate investments, and I'm looking for good opportunities. If real estate prices fall, that would create better opportunities for me to come in and buy. Now, just think of it this way. In the real estate game, in commercial real estate, you have something called the cap rate. The cap rate is essentially what return are you getting. So if I was buying $1 million property with, say, a 5 cap, that means it's going to generate a 5% return on the property, assuming I bought the property all cash. So if I paid $1 million from my bank account to buy $1 million property and it had a 5 cap, that means it would make $50,000 a year in positive cash flow from the property. Now, when you go out and you try to get a mortgage on this property, a commercial mortgage, you might be paying 7% on that mortgage to get a property that's paying you a 5% return. When you have the return on the deal, the return on the property paying you less than what the mortgage is, it's very hard to make the numbers work. And that's where something's going to have to change. Either the Fed's going to have to cut rates to support these prices, which would cause a whole lot of other issues in the economy, or eventually real estate prices are going to have to fall, commercial real estate prices, in order to justify people to continue buying these deals. Now, you are still seeing people buying these deals, losing money on the deals today because they're thinking, I'm going to be able to sell this property for a big profit in 2 years, or I'm going to be able to grow the rents to make it a good deal. And, that is possible. But for me, I don't like to play that game. I want to buy properties that are cash flowing pretty much out of the gate after I can come in and do my renovations and all that. So that's kind of the difficulties we're seeing in the real estate market right now. And then in the stock market, I also have my active investments, which is where I'm looking for good companies for me to come in and buy. Now, again, most people shouldn't be buying companies if you're not willing to put in the time, effort, and research to keep up with the company and do all that. This is just what I do. With my stock market investments, again, I'm being pickier. I want to not overpay for a company. And so I will wait until I see better opportunities or a good opportunity out there. If I see a good opportunity, will I buy? Absolutely. But if I don't see a good opportunity, I'm not going to come in and just throw money into something because, I just want to put money somewhere. Now, again, I have a lot of money in different high interest savings accounts. That way, at least I'm generating something on my savings. But yeah, it is a weird time right now. And this is where understanding the different risks out there. One risk is the economy is slowing. Will it continue to keep slowing or will it start growing? The second risk is inflation. Yes, inflation is on the way down, but inflation is still high. This inflation hurts the value of your savings. And third is, where is the economy going to be in 12 months? And that is the big question mark because we don't know what the Fed is going to do. We don't know what the government's going to do. And things can change very quickly. Like we saw things change very quickly in the banking sector as soon as Silicon Valley Bank collapsed. And that completely changed things in the banking sector almost overnight. And we could see a lot of changes happen in the economy quickly as well. And this is where now you don't want to jump to something, but understand the different risks that are out there. Understand where are the benefits, where can you find the opportunity. But it requires you at its core to be, one, financially prepared, and second, to be financially educated. Because if you don't know how to invest or where to invest or what to do, it doesn't matter if you have the money to invest. You won't know what to do if you don't know how to open up a brokerage account, if you don't know what is an ETF, if you don't know what a stock is, if you don't know what an index fund is. I have a ton of videos on my channel. Go watch those to start learning about what is an ETF, what's an index fund, how do you start investing, what is the stock market, how to invest in real estate. I have a ton of videos on my channel that you can watch for free. So if you want to watch those, go ahead, watch those. But then it's also being financially prepared, because if you see a great investment opportunity, but you have no money to buy it, you can't capitalize on it. And that's where preparing when times are okay, that way you can capitalize on things when they're not okay, is so important. And understanding this is what wealthy people do, that way you can take advantage of it as well. But the last thing that I want to say on this is the importance of patience. Because when it comes to investing your money, I love what Warren Buffett says on this. He says that the stock market is a device that transfers money from the impatient to the patient. And the reality is, if you want to be able to capitalize on opportunities, you have to be patient, because when everybody thinks something bad is going to happen, it tends not to happen. When everybody thinks something good is going to happen, that's oftentimes when something bad happens. And so this is where you have to be patient. And a lot of people have been predicting a recession, and kind of people have to get out of that water of, well, I've been waiting too long for this recession to happen. I don't think it's going to happen anymore. And people get into that, everything's going to be just fine camp. And that's generally when things start to turn south. But it's the matter of just patience and paying attention to what's happening, which is so important because, well, there's a lot of money. A lot of money. I think more than anyone really can guess was created in the last number of years. And that money has to be dispersed and spent. And that's what's going to cause that real tipping point in the economy. And just look at what some of the great investors are doing. Like Warren Buffett is sitting on a $130 billion cash pile. This is the largest cash pile that he's ever been sitting on ever. Why do you think he's sitting on that $130 billion worth of cash? He could go out and buy a lot of companies today, even at the valuations today, with the $130 billion. But he doesn't want to because he wants to find a good opportunity. He wants to find something that he believes is a good value at a good price for him to buy. Now, he does say that now, today, he can finally earn some money on this $130 billion because the treasuries where he's keeping this cash are finally paying some interest. But he wants good opportunities. And so it's just that matter of being patient and being willing to take advantage of opportunities when you're coming your way. But again, this comes back to two things. You got to be financially educated. Invest in your financial education right now. And when I say invest in it, I mean, first, invest your time. Watch videos, listen to podcasts. This is all free. Then invest money. Read books. There's a ton of really great books on financial education. I've made videos talking about some of my favorite books on financial education, earning money, investing money, and all that. You can watch those videos as well. Maybe take classes, maybe do coaching. Whatever. I mean, there's all different types of education that you can invest in depending on how involved you want to be. You don't have to go out and do all that, but at the very least, start with the free education. And then on the other end, you got to be working to build that financial cushion. That way, one, you're protected against an economic downturn, but then second, you have cash to be able to capitalize on opportunities that might come your way. I just hired a new team member for Briefs Media, and he told me that our onboarding process blew his mind. Not because of the work product or the process that we have at our company, but because of the money strategies that he saw. Let me show you. This is what the average person does. The average person makes money, and then they use this money that they earned to fund